Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you live from the Money Show in Orlando, Florida. First off, apologies. I am in a hotel room, as you can probably tell from my hotel room like background. That is not a virtual background. That is my current background here in at the resort in Orlando. I continue to look just above a different monitor because that's where my camera usually is. So if you catch me just staring up at the wrong place, that's probably what's happening there because old habits die hard. Apologies if there are any technical glitches with this. I'm doing my best to stream from away from home, but I hope this comes through okay, and hope that despite any particular issues, that it still is a good review of market conditions. My name is Dave Keller. I am here with Market Misbehavior from Orlando, Florida, and this is Chart This, our daily market recap show. Today, I did not look at the markets a ton unless when I could grab time to do so between interviews. It's actually been a pretty interview-heavy day here at the Money Show. We recorded podcast episodes with Mark Skousen, with Peter Schiff, Adrian Day, and then I just finished with Mike Turner talking about systematic trend following. So I've interviewed some economists, some money managers, systematic portfolio managers, and I look forward to sharing a lot of those comments and thoughts with all of you here in the days and weeks to come as I upgrade their podcast episodes. Also, thanks a number of viewers introduced themselves here at the Money Show as I invited you to do so. I'm so glad that you did. It's a real pleasure to learn a little bit more about each of you and where you're from, how the show and the content has helped you kind of make sense of the markets. And down the road, if you see me at an event, I hope you'll take a moment to say hello to me. I appreciate it very much. Market conditions overall, stronger earlier in the day, but through the course of the day, rotating lower. So as I go to our market recap, we're going to see that the charts looked a little bit stronger kind of through midday, but by the afternoon hit here on the East Coast, we got a rotation lower. The S&P did finish slightly lower. The Nasdaq and the Dow just very close to that as well. Let's go through the charts in a little more detail and see how things played out today. So we can see the S&P really no change essentially from yesterday's close. We ended the day around 5841 and a half. That's essentially where we were, as one S&P point away from yesterday's close. So we'll call that unchanged. The Dow was up about 0.4% and was the top performer of the three major U.S. indexes. The mid-cap and small-cap indexes split. The S&P small-cap index was down about 0.2%. I mean, small caps continue to show signs that they're going to emerge, and then I feel like fail to do so. But it's one day. Let's not draw too many conclusions from there. The VIX about a half a point lower. So the VIX yesterday, we didn't have a show yesterday because we were flying out here from Seattle. But the VIX went steadily lower through the course of the day yesterday as the market pushed higher. And today, a little bit more. So the VIX is now below that 20 level. For me, that is a red flag rolled up and put back in the flag bag, I guess, for lack of a better term, waiting for another sign of extreme volatility or really high volatility. I tend to think of volatility as either good or bad, just for simplicity. I do have some nuanced levels on my chart of the VIX, but my basic read is above 20 is bad for markets. Below 20 is usually pretty good for markets. So for now, market making new highs, VIX below 20. Things seem pretty decent here. We'll see what happens when we get to some of the individual charts. Tell you what, bonds selling off today, though. The TLT was down about 1.6%. The 10-year yield back about 4%, around 4.1%. The long bond yield almost to 4.2%. So we're seeing the entire yield curve kind of push higher here. The yield curve still inverted, but not by much, depending on how you measure it between different duration points. But overall, you're certainly seeing the upper end pop back higher here. The 10-year yield had gotten down to around 375 or so, and now has popped back above 4%. I think a big part of the argument for some of those sectors like home builders and maybe consumer, especially like luxury goods, where people are going to have to borrow money to buy something, certainly seems like lower rates are a big part of that bull case. So if rates continue to push higher from here, that sort of takes that particular tailwind away. I did want to mention the dollar up about 1/3%. Looking at commodities kind of split. I've talked about commodities with a number of people today. A number of the portfolio managers I interviewed today either have sizable gold positions or ran a gold fund or part of their fund primarily in precious metals. So I had a lot of interesting thoughts about that. A lot of discussion about gold versus the dollar, which I'll look forward to sharing some of those thoughts with you as we get the episodes edited up. But it did certainly make me respect the uptrend that we've seen in gold. Copper prices down by about 0.7%, and crude oil slightly higher. Energy was indeed the top performing sector today. Bitcoin down slightly today, but overall still quite strong relative to where we've been here in recent weeks. Bitcoin's currently sitting just above 67K. You can see Ether prices just above 2,600, and most of the rest of the top 10 cryptocurrencies on stock charts in the red. All right, let's look at the 11 S&P sectors. Very much a mixed bag, kind of 4 up, 7 down sort of setup. You can see energy number 1 up 0.5%, technology number 2 up 0.3%, financials number 3 up 0.3%. Now, financials obviously a key area to focus on because of all the earnings this week, right? Earnings season for financials really started aggressively on Friday through the course of this week, Tuesday, Wednesday now, and into Thursday. We've seen a bunch more financial stocks report. I think I grabbed Blackstone's chart and put it on the list to review here later in the chart review portion of the episode. But certainly you're seeing breakouts in the KBE, the KRE, big bank ETFs. I keep thinking as I watch the regional bank ETF do well, think of my conversation with Mike Singleton, where he really singled out regional banks as an opportunity, given the interest rate environment and the likely direction that's headed going forward. On the downside, you can see some defense on the bottom. Utilities were down 0.9%, REITs down 0.7%, healthcare down 0.6%. Looking at the Magnificent Seven, and we do have one of the Mag 7 names reporting today after the close, Netflix, coming out there. It looked like it was popping a bit higher in the aftermarket. I'll take a look at the post-market trading here in a little while, but just to catch up on the major moves today, 3 of these names down. Netflix selling off going into earnings today, down over 2%. Alphabet down 1.4%. That's one of those charts that it's kind of in limbo, right? Alphabet kind of not quite breaking out, but not quite breaking down, kind of right in the limbo phase. Tesla down slightly from yesterday's close, down 0.2%. As a reminder, I can see comments that you're putting on wherever you're streaming this, on Facebook, on LinkedIn, on YouTube, on X. I appreciate you so much tuning in from wherever you're at. Please drop a comment on whatever platform you're on. I can see all those comments. I'll try to make time for a chart or two or a question or two at the end of the episode. Anything we don't get to, we'll put in the mailbag, which we'll share with you next time we have a mailbag episode. All right, looking at the charts here to continue today's discussion, I would say the S&P, actually, sorry about that. I meant to show the market carpet. We actually used this in the presentation I just did with Mike Turner. For those of you that aren't here in Orlando, I'll show you the chart that we referred to. This is the year-to-date heat map. So we usually use this heat map as a one-day change just to see what happened. And I think it's a great way at the end of a trading day or even during the day to just get the sense of what's working and what isn't, and look for outliers and look for themes across sectors and types of stocks. But looking at year-to-date performance, and again, use kind of the same framework we've talked about before. Step one, look at the big picture. And the big picture, what's the overall trend? I would say I see probably more green than red, but I see not a lot of kind of a neutral color. And these are year-to-date returns, right? So while NVIDIA is up 184% and Broadcom is up 69%, Meta's up 67%, all of which are pretty decent returns. You can see Merck is actually slightly lower. Actually, a lot of healthcare names are kind of flat, if not slightly lower. Banks in general are up, but not by nearly as much as you see with something like an NVIDIA and things like energy, like discretionary stocks. Quite a mixed bag, right, of things that have been working and things that are net down, that are down in absolute terms year to date. And I think that's the reality of where we're at right now. Even though the breadth conditions in a lot of ways are quite strong, there are plenty of stocks that are not going up year to date, or certainly not trending in the right direction. Now, having said that, let's look at just today's trading, and we can see that's called priming, right, or anchoring, where I give you one image, then I show you the second image, and now this looks really bad because I just showed you all the green of the year-to-date returns. So let's not get too. That was a mean trick to play, a mental trick, behavioral trick, I guess. Here's what happened today, though, and honestly, what this tells you is there's a lot of kind of neutral, beige color here, right? Not a lot of things moved a lot today, is the way I would describe it. In terms of the big movers, right? Look at the big sort of overall vibe that you get by looking at this visualization. I don't know about you, but for me, I'm noticing a lot of big red blocks that are kind of jumping off the page, right? At the bottom middle, you have in healthcare, things like Elevance Health, DaVita, DVA, Moderna, Mettler Toledo, Molina Healthcare is a managed care provider, down 12.5%. I'm noticing in utilities, right? A lot of the utilities kind of okay, but then there are a couple that are down pretty good, like NRG down 5.8%, Constellation down over 3%. In industrials, you have a railroad like CSX down 6.7%, Equifax down 3.3%. So I'm noticing a lot of individual stocks and not really as much of a sector theme, but more of just a reality today, because you see a lot of things that were not up today. Second way I use this is by looking at the big dogs, the big charts. I would notice that Broadcom, out of all of those kind of top 20 names, probably the best performer, it looks like. NVIDIA up 0.9%, which certainly helps. But Meta, Apple, Microsoft, basically like the market, Tesla, Amazon, these were within 0.3, 0.4% of the zero line. So really just not a big movement kind of day. Finally, it's looking for smaller opportunities, things that are actually doing well despite the fact that the market was down, things that jump. So the little green boxes are basically what we're looking for. I would say in financials, Chubb, Travelers, these are insurance names. Travelers up about 9% today. A lot of these are earnings names this week. Within technology, we mentioned Broadcom up almost 3%, about the same for Micron. Micron's a really interesting chart. I actually didn't include that chart, but we'll look at that next if I can remember to do so. Humana is another one up 4.3%. You see a number of random healthcare names. And again, a lot of random other ones. This is a really good way to use a visualization like this, in my opinion, is sort of look at the overall feel of the chart. What's your impression of the overall trend change? Look at the big names that obviously have the biggest weights in the benchmarks, and then look for the outliers. Look for things that are up a lot or down a lot, and ignore the stuff in the middle. And that's probably pretty good. I'm going to save the chart of Micron. I almost said Metron, Micron. There we go. That'll pop it at the bottom of the list. All right, let's get to the charts here. So we can see the S&P 500, kind of a down day, right? So what's happened in the last couple of days, we didn't have a show yesterday, but yesterday's show, we obviously came off a bit. And I would say, on Tuesday, we sold off. That was that bearish engulfing pattern with the big up day and then the down day, where day two kind of engulfs day one. It wasn't really a bearish outside day, which would mean a wider range, but it was a bearish engulfing pattern. Yesterday was kind of a snapback rally. And instead of following through to the downside, we traded higher, but remained largely within the range. Today, which looked like kind of a negation of that bearish engulfing pattern, but we traded back to the low. So I don't think I would consider that a violation of the upper end, because we closed back below it. And general way that I use any sort of support or resistance level, it's okay to trade through it, but closing through it is it means something more significant. So the fact that we traded above to a new all-time high, so we did make an intraday high today, but the fact that we closed back toward the lows of the day right at yesterday's close tells me that there was selling going into that peak, and that's not really a bullish sign. The RSI, by the way, not overbought yet. The last time we were overbought was in mid-July, so we don't really have that traditional sign of an overextended market using price momentum. But again, we'll see how today, the rest of this week plays out here with Friday's session. But overall, certainly feels like we've stalled out at least a little bit. Did want to mention the breadth conditions, obviously quite strong. Not all of these advanced decline lines are updated yet for today's close, but given how it was sort of a flat, nothing sort of day in terms of the breadth conditions changing, I wouldn't imagine most of these to change dramatically. So all four advanced decline lines, and that's the New York Stock Exchange on the top, large caps, mid caps, small caps, all four of these have made a new all-time high in the last week. And that's bullish, right? When new highs are bullish, and AD lines all making new highs are pretty bullish as well. So overall, I would read that as a pretty constructive follow through. The McClellan oscillator, as of today's close, is that true? That might be for yesterday's close, actually. It is. This is as of yesterday's close. With the pop higher, we did get the McClellan oscillator back above zero. I don't like to update this until we have multiple days through the zero line, just to minimize whipsaws. So we'll see if today, I don't know what will happen today, given the fact that it was kind of a weird sell-off into the close. We'll see what the final data looks like. But if we would remain above that zero line, that would be a switch back to a bullish McClellan oscillator, which we have not had for a little while here. Pretty much the whole month of October has been with negative short-term breadth, according to that particular methodology. Looking at highs versus lows, or new highs and new lows, you can see that as of today's close, we had almost 16% of the S&P 500 making a new 52-week high. That's the series that you see at the bottom, the big green bars. I think one of the biggest changes we've seen in the last week, when I think about the markets and I think about what has happened over the last week, the expansion in new highs is probably the most constructive thing I can tell you. Besides the fact that just the S&P is going higher and making new highs, the fact that more and more individual stocks are doing that, I would argue that's probably the more constructive takeaway, because that shows you there are plenty of stocks that are leading the way higher. Those are your early leaders, the ones that are pushing higher despite whatever else is happening in the world. The more green that you see, the less red, the more constructive that is. And I would argue that changes the configuration that we experienced from mid-September to mid-October, which was the market going higher on weaker new highs, right? Less new highs every time we're making a new 52-week high for the S&P. That's not particularly healthy. That's changed here, as a lot of stocks which had stalled out a little bit earlier this month are now starting to resume their uptrend. That's kind of a bullish development. One interesting thing to note on my YouTube channel, on Friday of last week, I did a video particularly on Chaikin Money Flow. Is that true? I think so. It's a bit of a blur. It might have been Monday on stock charts, so apologies if I don't have the right spot for that. I actually think that was Monday on stock charts. But I did do a video in the last week about Chaikin Money Flow, and particularly talking about the fact that the trend has been higher in the S&P, but we're starting to see lower volume. And that's what I wanted to mention today, right? If you look at the last week or two, we're making new highs, but the trend in the Chaikin Money Flow is actually going down. You can see that similar pattern in July and March, in July of last year, where the market was going higher, and then you saw a decline in the Chaikin Money Flow. And the way that that's derived, you should watch the video for the full information. Pretty sure that was Friday on my channel. What happens at the end of a big move is you often have these distribution days where, even though the S&P or the NASDAQ are making new highs, you're actually getting distribution where investors, I guess probably anecdotally speaking, the smart investors, smart money, are starting to unwind. They're starting to sell into that strength at the end of the move. All of that selling causes the Chaikin Money Flow to go more negative because we're finishing more at the lows of the day. And a day like today probably is part of that story of the Chaikin Money Flow starting to trend lower, even though we're making new intraday highs on a given point. So keep an eye on this chart for sure here in the weeks to come, because major tops have usually been marked with a divergence from that indicator, really derived from volume readings. All right, to finish off here, we'll look at some names on the move in the news, earnings names a lot today, because we're in the meat of earnings season. CSX is where we'll start. CSX is a tough chart to show you because it was a really good breakout as of 2 days ago, right? What happened was 2 days ago, we actually closed, it might have been a little bit further, it might have been Monday's session, where we started to break above 35. We weren't quite above those July peaks. We're starting to break above this congestion range in September and October. We then had 2 more days of trading higher. Now, yesterday, we actually closed near the lows of the day, and that was a bit of a concern. Today, though, with the earnings miss, down about 6.7%. We opened below the 50-day. We close lower. For me, that means I'm now watching this support level down on the lower end of that range. A chart that looked really good, that looked like a good breakout, failing to do so. That, this example of CSX, when we talk about earnings season and the risks going into it, for me, the risk is stocks get dinged, even if they beat estimates. And I didn't look a lot into CSX to tell you exactly what happened with this particular stock, but I would tell you the fact that we gapped lower means either we missed our already lowered expectations, because most companies have seen their estimates come down and they come in a little bit under a lower expectation, which would not be good, or they beat expectation, but their forward guidance starts to come down, right? They sort of lower expectations going forward. That's what the market's really probably more concerned about, are those future earnings. And so either way, it's not good. It's not a healthy bull market event to have stocks that are good breakouts that fail, right? Failed breakouts actually tend to happen more in a bearish rotation where you see instead of buyers, thrilled to accumulate more of different stocks on their earnings, they're actually selling into that and unwinding positions. Now, it's not all bad. I would say financial is probably one of the big victories, early wins so far from earnings season. Blackstone today, you can see up about 6.3%. That's making a new all-time high around 170 or new 52-week high at least. You can see we're overbought, nearing that extremely overbought region. We've been overbought a number of times here in the last couple of months, and they've led to brief pullbacks at or near the 50-day moving average. But overall, I would say the trend is strong, and that's a really beautiful rotation out of that consolidation that we experienced in the first half of the year. Now the second half of the year really showing quite a bit of strength. And I think earnings today probably sets the stage for further strength in financials. Molina Healthcare was one of those that dinged lower. We talked about Molina Healthcare earlier this week on my webcast that I did on the election season and what types of stocks could do well in a Harris presidency versus a Trump presidency, which stocks could do well in either case. And I would say Molina Healthcare was one of those we talked about as one of those Harris names. It's a managed care name where, arguably given their policy positions, something where you could see an influx of investment from a Harris administration. Today, not feeling the love, down about 12.5%. The gap down takes us right back to the July low. So the contrarian in me says, all right, we've gapped down to previous support. Maybe I take a speculative position and see if that's the low. It's not the type of trading I usually do. On something like this, I would most likely wait for signs of accumulation. The fact that we're near support tells me we could be at the point where we start to see a positive rotation, but I'd much rather wait to see that bullish rotation, right? The MACD indicator giving a buy signal as an example of that, which I'm not showing here, but that's the kind of thing I would look for to let Molina prove itself to me first. All right, Alphabet, ticker Google. You can see this is an interesting one. I would say this is in no man's land. I wrote about this on CNBC in the last couple of weeks, and I would say it's still sort of TBA. What we talked about was this inverted head and shoulders pattern. And if and when you break above the neckline, that basically measures to previous highs or get very, very near that, right? It suggests that we make a run up to the 180, 190 kind of range based on the height of that pattern, but we have not broken above the neckline just yet. So for me, this is one of those charts where you set an alert for like 169. If we would break that, that would be completing the rotation away from or through resistance and pushing higher. For now, this is a stock failing to break through resistance with the RSI remaining more in a bearish range. Gets us to actually some Micron, and then I'll go back to Netflix here to finish off. Micron is a semiconductor name, obviously. Nice bumps today, up about 2.5%. It was trading higher earlier. I was wondering if it was going to clear that September peak. It didn't quite do so, but it did make a new closing high for the last couple months. That comes after the higher low. And just look at this sort of sign of accumulation. We talk about signs of accumulation, something like a support level that is then retested. We don't make lower lows. We actually hit a similar level. We then break higher. We make a higher low. As long as a stock like this keeps making higher lows, I would say that's a fairly constructive pattern. Final chart here, and then I'll bring any questions that I see. Netflix, this is one that's reporting after the close today. It finished today down 2%, it's always interesting to see what a stock is doing going into earnings. That tells you a little bit about, or a lot about the expectations going into it. So going into today's report, not a lot of optimism as we broke below the 50-day moving average. For what it's worth here, and I always hesitate to draw too many conclusions in the aftermarket. It's a lot lighter volume. And, when you have a company reporting earnings and they have an earnings call, there's a lot of volatility around that. And then tomorrow is when you really see what sort of change in valuation is going to be priced in. But for now, aftermarket, it's trading up around 710, which is right around I think that's the 20-day moving average there in green, but sort of gapping back above where we closed today. So felt a little bit more like negative sentiment going into the close today, but today, the after hours for now suggesting a nice upside follow through. When a company reports after the market like this, after hours is interesting as an indication, but I always like to look for the next day to see what sort of follow through we might get. That is it for our show. I don't see any questions, so we're going to wrap it here. I apologize for the late start. We had to start around 4:30 Eastern because I had to wrap up with the podcast and everything we're recording here at the Money Show. I hope it's worth it to have a little delayed start. I've had some really good conversations. Again, some of the interviews I had with like Peter Schiff and others were just fascinating. Some really thoughtful, smart, experienced investors. And I look forward to sharing some of their insights with you in the week to come. All of those interviews will be posted on my YouTube channel called Market Misbehavior. And wherever you're streaming this, I appreciate so much you doing so. And again, thanks for those of you that are here in Orlando and saying hello. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Thanks so much. And we'll see you again real soon. Bye now.